The era of open, borderless commercial AI innovation is officially dead. On June 12th, the United States government shattered the foundational assumptions of the entire tech sector by issuing an emergency export control directive. That forced Anthropic to instantly, globally disable access to its flagship Claude Fable 5 and Mythos 5 models over a disputed jailbreak vulnerability. Capabilities that multi-billion-dollar enterprise stacks and hedge fund algorithms depended on in the morning were entirely erased by the evening. Now, Washington is turning its sights on OpenAI's latest frontier release, actively threatening to restrict its compute parameters under the umbrella of national security. Meanwhile, Beijing and Tokyo are moving at hypervelocity to fund and release sovereign models that completely bypass Western choke points, putting global financial stability at risk. They call me Noel. Welcome back to the Signal and Noise podcast. Before we dissect the structural demolition of the AI capital allocation thesis, take a split second to hit that like and subscribe button. Today, we deliver a raw 30-minute diagnostic autopsy on the sovereign weaponization of artificial intelligence. We will analyze how the Fable 5 shutdown rewrote corporate risk models, expose why global capital is violently fleeing U.S. centralized AI equities, and map out the exact professional playbook to protect your portfolio as the silicon curtain falls. Let's dive in. Let's look directly at the engineering and financial plumbing of what happened on June 12th, because it marks the exact moment the tech narrative shifted. The narrative shifted from growth utility to sovereign liability. For 2 years, every software company and trading firm built under a single assumption. If a model is available via an API, it is a stable, persistent utility you can safely anchor your business to. The Department of Commerce just vaporized that assumption. The U.S. directive ordered Anthropic to immediately suspend access globally. Anthropic had no choice but to execute a blanket global shutdown. What makes institutional capital desks sweat is the extreme fragility of the trigger. The government cited a narrow, non-universal jailbreak. This completely breaks traditional software as a service risk metrics. Standard SLAs are written for downtime, not a model vanishing for national security. If you are an institutional fund manager, you suddenly realize that company has a massive single point of failure with a regulatory trigger. Valuation multiples are getting ruthlessly compressed because their foundations are built on shifting political sand. Now let's look at the secondary shockwave, the expanding regulatory net over OpenAI's new models. Agencies are proactively limiting deployment velocity. This is triggering a massive, silent capital allocation reversal across the global equity grid. Tech giants have engaged in a historic capex race. The financial underwriting of that massive spend depended on shipping powerful models at a breakneck pace. Now, the monetization horizon is stretching. Wall Street analysts are looking at the staggering bills for energy and hardware and realizing the return on investment model is broken. If model software cannot be deployed freely, the demand for underlying hardware hits a brick wall. This explains the correction in semiconductor equities. The money isn't leaving because of a lack of capability. The state is capping the code, and that means the capital is hitting a hard ceiling. This brings us to the core structural danger, the asymmetric sovereign arbitrage. The U.S. believes it can unilaterally choke off frontier capabilities. But the global technology matrix doesn't operate in a geographic vacuum. While Washington locks down domestic labs, international competitors are sprinting. China and Japan are aggressively pouring state-backed capital into alternative models. China is leaning heavily into open-weight architectures. By cutting access, the U.S. is inadvertently forcing the global developer base and banks to permanently migrate their dependencies to Asian infrastructure. If the financial plumbing of the future is built on models controlled by state adversaries, Western financial security is systematically compromised. Capital is highly fluid. It detests structural instability. If an American model can be deleted on a Friday, capital will fund jurisdictions where that risk doesn't exist. Let's bring it all home to the definitive structural verdict on the sovereign weaponization of the artificial intelligence sector. The noise. Recent government crackdowns are isolated legal skirmishes that will be resolved through lobbying. That is the noise. The signal. Frontier AI has transitioned from a commercial boom to a restricted national security asset. Geopolitics will prioritize dominance over valuations. How do you position your capital? Entirely throw away the old, naive tech playbook. Stop evaluating stocks based purely on theoretical scale. You must explicitly price in regulatory exposure. If an enterprise relies on a single U.S. endpoint, it is a high-risk gamble masquerading as an investment. Focus your capital on the agnostic infrastructure layer. The ultimate hedge is investing in localized power grids and alternative semiconductor supply chains. The soft tech bubble has burst. The hard geopolitical tech reality is live. Understand the plumbing or remain the liquidity. Stay sharp, stay focused. That's it for this urgent edition of the Signal and Noise podcast. Make sure you hit that like and subscribe button right now. Protect your capital allocations, and we'll see you on the next block.